This episode is sponsored by Lendlord. Lendlord is an online platform designed to help landlords and property investors manage, track, and optimize their real estate investments. Lendlord has a whole suite of free services, including a deal analyzer, property flipping calculator, tenant CRM, profit and loss reports, and so much more. I personally use Lendlord to track all my rental properties. Think of it as a modern day upgrade to boring old spreadsheets. Lendlord also has useful tools to analyze real estate deals, allowing you to calculate cap rates, IRR, and annual cash flows. It's completely free, so check out the link in the description below and let me know what you think. Hey, Steve Saretsky here. Welcome back to the show. We got lots to touch on this week. We get Canada's population figures, how it's impacting each province, and we've got an update on the economy and what's happening in the U.S. banking system and how that could potentially morph into a savings and loan crisis, a credit crunch, credit crisis, so to speak, and how that could obviously impact us here in Canada. So I'm going to walk you through all of that, but we have to start things off with Canada's population growth statistics. So they are truly mind-boggling. Stats Canada just came out this week with the annual population figure numbers in Canada. So we added just over 1 million people in 2022. That far exceeded all previous data points going back. We had to go all the way back to the 1950s. So our country is growing at an unprecedented pace, the most of any advanced economy. And clearly this is putting a strain on our infrastructure and our housing. But, there's a couple of things that I need to walk you through here, which is, the federal government set a permanent resident target of 460,000 people a year. They're trying to ramp that up to 500,000, but they don't account for non-permanent residents, which is foreign workers and foreign students. And so they said, initially, if you add those numbers, it might be 800,000. It turns out we actually exceeded 1 million people. So the government doesn't seem to have a strong grasp on just the massive influx of people that are coming to this country. And again, putting strain on our infrastructure. Because in Canada here, we average about, give or take, about 250,000 housing starts per year. Now, housing starts is not necessarily net new housing, because what happens is, a lot of the times you take, let's say, 5 single family houses, you tear them down and you build 20 townhouses. Well, that's only net 15 new dwellings, but it would count as 20 housing starts. So the reality is, in short story here, is that clearly when you're adding 1 million people and building, let's say 250,000 homes, it's just not enough. We're already in a housing crunch. We're already in a housing shortage. And 250,000 isn't going to cut it. And the problem is that it's ultimately government policy, right? It's a decision to set immigration targets, and it's this decision to allow developments to be approved and building permits to sort of be passed. And so you've got the federal government, which is responsible for setting immigration targets. You've got the provincial government, which just kind of stands in the middle. And then you got the municipal government, which is basically responsible for approving all new housing supply. And so all 3 levels of government aren't actually communicating. And this is the problem with big, slow, bureaucratic government. It is slow, it is inefficient, and it is actually creating a lot of the issues that we have in this country. So immigration is what Canada is built on, but there are repercussions. You cannot, if growing your economy or growing your population at the fastest rate, or having the most people in your country was the model for economic prosperity. A lot of these developing markets, third world countries, would be very prosperous, and they're not. So ultimately, I think it's kind of a fine line that we're juggling here. But the one thing that I'll point you to that nobody seems to be talking about is the growth in, 2 things. We've got huge outflows in those numbers that you can see interprovincially. So about 50,000 people left the province of Ontario for a different province. There was negative interprovincial flows, and Alberta saw nearly a 50,000 increase in interprovincial flows. So basically, people are leaving some of these very expensive places like Ontario and going to the more affordable, greener pastures. That's been part of our macro framework for several years on this channel. It's sort of playing out in full view. Now, the only other thing to keep in mind is, everyone's talking now about this, million people, and obviously the real estate industry sort of loves it. It's, hey, we gotta build more. Very, very true. We definitely do. But the one thing to keep in mind here is that the non-permanent resident growth actually dwarfed the permanent resident growth. And we haven't seen this since 1989. The last time we saw it in 1989, it was at the precipice at the beginning of a significant housing downturn. And of course, those immigration and population growth numbers thus rolled over, because what happens is a lot of these temporary foreign workers, non-permanent resident foreign workers that come to this country, when the economy slows down and you go into a recession, all of a sudden there's not as much work to go around and you decide to leave and you go back home. And so that, I think, is a very likely scenario if Canada, I think when Canada goes into recession, you're going to see those numbers roll off. So you've probably seen the top, and it's not to say that we're still not going to have very high immigration numbers, but a million clearly is not sustainable as the economy enters recession. You'll see those numbers roll off, as they do in every single downturn. And so speaking of downturns, we've got all of our eyes focused squarely on what's happening in the U.S. with all these regional banks that are starting to go poof in the night. Again, this should be no surprise. We've talked about it on this channel. When you raise interest rates, when you keep them low for basically 10 years, you keep them essentially at zero for 10 years with massive amounts of quantitative easing, and then suddenly jack rates by 400 basis points in less than 12 months, things will blow up. And so we've always said that given the debt loads of 365% debt to GDP, this was clearly not going to be sustainable. And I believe, anyways, I'm certainly no banking expert, but I believe in the fact that there's usually never just one cockroach, and this problem has not gone away. I think we saw $100 billion worth of deposits withdrawn out of U.S. banks over the past 7 days, the most since the onset of the early days of the pandemic when people were freaking out. So this problem has not gone away just yet. And what is important to focus on here now is in the U.S., you've got a lot of these sort of small regional banks, right? And the regional banks are largely responsible for lending to, commercial real estate, for example. And so, they've issued a lot of debt to a lot of these commercial real estate. One of the things you can think about is office buildings. In fact, there's about $900 billion worth of commercial real estate that is coming due for refinance over the next 24 months. It's $900 billion. And a lot of this is going to be at the helm of these regional banks. And so what's going to be interesting is, you can think about during the pandemic, right? All these people have shifted from work from home. Clearly we have too much office space, but a lot of people are locked into these leases. These leases are now going to be coming up for renewal in the next 12, 18, 24 months. And a lot of companies, a lot of business owners are just like, yeah, you know what? I don't think I need it anymore. I'm just going to let it go. And so a lot of these, that's a huge headwind to begin with. And not only that, but if all these regional banks, these smaller banks in the US are seeing their deposits leave, and they've got these buildings coming up for refinance, is going to be who's going to want to refinance it? Who's going to have the ability? And you're now stuck with an asset that is fairly illiquid as the economy slows and as there's an overabundance of office space. And so I'd like to clip in some comments here from Barry Sternlicht of Morningstar, or Starlight, sorry. They are one of the largest commercial property players in the space, but I thought he had some great comments. So let's clip to those right here.
The crisis in real estate and in fixed assets is slow. And as loans mature, and now you're seeing every day you'll hear about an office building going back to a bank, and that the Fed was also all over they were spending a lot of time on the systemic banks and telling them, do not increase your exposure to office buildings and real estate. Well, I just wonder who on earth they think is going to refinance that office building on Park Avenue. And I think if you take that to its logical conclusion, values will drop. It's a $3 trillion asset class, office buildings in the United States. It's not small. And it's a situation where they don't lend and other people can't lend, these buildings will go down. Cities and municipalities rely on real estate values to pay for all their services. Receipts go down, and you wind up in a really bad place, which you can see. You do not have to see the car hit the wall to know that it's going 8,000 miles an hour, and it will hit the wall. It will most hit the wall. I've always focused with you.
When you say hit the wall, the car hit the wall, you mean the commercial real estate market with the office buildings?
The economy will have a hard landing. I mean that he is using a steamroller to get the price of milk down 2 cents. He's to kill a small fly.
So I think Barry brings up a lot of very important points, right? Again, these regional banks are largely responsible for the bulk of financing of these commercial loans. You think of small business owners and stuff, someone that needs, let's say, you're a small business owner, you need to go buy a tractor, you're going to take a loan out against that, a loan out against your business. It's the regional banks that are responsible for a lot of this entrepreneurial activity in the U.S. And so again, if their deposits are fleeing and they don't have the ability to extend credit, credit is the lifeblood. Credit is the lifeblood of the economy. And so you're going to run into these frictions, and it could be morphing into a savings and loan crisis like we saw in the 1980s, and a potential credit crisis. Again, this is just my view. I think this is escalating. I think that central banks are sort of stuck. They're stuck because they've got egg on their face already from missing the inflation, which they said was transitory, and now they don't want to be seen as easing up on the gas pedal when inflation, at least from a headline perspective, is still running elevated in the 5 and 6% range. But in reality, a potential banking crisis or credit crunch is actually going to be massively disinflationary. But they're basically stuck, and so they were slow to raise rates. I think they're going to be slow or hesitant to actually pause or start cutting rates. But interestingly enough, is markets now. Interest rate markets are now actually pricing in Fed cuts for later this year, saying that the Fed is now done. So again, you can believe the markets, disbelieve the markets. It does not matter. Bond yields, of course, rolling over. We're seeing the Canada 5-year bond now coming in the 2.7 range, which clearly should suggest much lower mortgage rates from here. But again, given what's happening in the banking world, given the risk premium, given the concerns about the economic outlook, banks are sort of battening down the hatches, and they are not, at least not yet, they're not passing on these savings to their borrowers. And I don't really expect them to. I think we're going to see some banks cut, fixed rates by 10, 15 basis points here, maybe in the next couple weeks, but that's certainly far lower than they realistically should be. But again, given what's happening, given the outlook, clearly there's some concerns in the banking world, and so those cost savings aren't going to be passed on to Canadian mortgage holders. This could ultimately create the credit crunch that is coming, credit being the lifeblood of the economy. This is setting up, and I personally am quite concerned about the setup here. And this, again, ultimately coming back full circle, right? You get a credit crunch, you get some softness in the economy, you get that recession, you get the job layoffs, you get the slowdown in immigration flows into Canada. So that's how we put it all together for you this week. So watching, waiting, it's very interesting to see the housing market here. What I can tell you anecdotally is, at least in Canada, at least what's happening in Vancouver and seemingly in the GTA, is like everyone's just kind of ignoring, recession potentially, banking crisis potentially, and people are, willing out there competing on entry-level single-family houses in the midst of 20-year lows in new listings. So again, despite 1 million people coming into the country, despite adding more housing, 20-year lows in new listings. And so people are out there competing for housing. Very, very, very strange times. But, this is what makes the show interesting, is we have something to sort of continue to talk about, continue to follow along. So I would say, from here, we proceed with caution.